You're listening to the Real Talk Real Estate Show with your host, Clayton Hepler.
Today's guest is Hadar Orkibi, the long-distance investor. His experience in real estate extends from being an agent in Israel to successfully completing triple net leases in both New Zealand and in the United States. But his accomplishments don't stop there. Between flipping multiple houses in the United States and completing over 100 units worth of multifamily, small and commercial multifamily transactions, today's guest is making a real impact on the real estate industry. So please help me in welcoming the man who is investing from halfway across the world, New Zealand, Hadar Orkibi. Hey, Hadar, thank you so much for joining with us today. As customary, I want to just kind of hear from you how your career in real estate started. Basically, take us from day one to where you are now, and we'll get into kind of your specialty in the real estate world.
Yes, sure. Thank you, Clayton, for having me. So my name is Hadar Orkibi, and I'm an American citizen based currently in New Zealand. We immigrated to New Zealand in the early 2000s. And before we immigrated to New Zealand, I was doubled in real estate through being an independent real estate agent for a while. But shortly after, decided that I want to be on the other side of the spectrum. I want to be where the real money is made and when there is more freedom, because you don't have to attend open homes and do walkthroughs, and you can be your own boss if you like. So in New Zealand, when I first arrived to New Zealand, I got myself educated. I was working in the vineyard and the orchards as a manual labor. I did a lot of work, early in the morning till late at night. Like from about 8 till 7. It's reasonable amount of work. And at the same time, I listened to CDs mainly. There was no podcasts or anything like that. We were using CDs, so I was educating myself about real estate through CDs and online forums, and started wholesaling. I started as a wholesaler, mainly assigning contract for a fee. So if the listeners are not familiar with the term, is basically you get a property under contract and you sell the contract for a fee. So I started like that, and gradually I was doing that in the breaks when I was having a lunch break in the time when I was working there. And gradually I picked some momentum with my wholesaler fees, and I started doing contemporaneous closing. So I built myself a database of investors, and that's almost 20 years ago now. So I was able to offload the deals to them, and then from smaller fees, from selling contracts for anything from about $5,000 to $20,000, the largest fee that I wholesale the deal for, I started doing what we call a contemporaneous closing, which is basically you buy for property. For example, I'll give you an example, easy number, for $100,000, and you sell it for 150. So you make the spread in the middle, which is $50,000 less your legal cost and whatever the cost was just to get the transaction conveyancing cost. So when you do double closing, typically there is a bigger margin in between, so you don't want to assign the contract for a fee. While I've done those double closing, I was able to accumulate enough down payment from the property trading, from being effectively a wholesaler. And then I became a flipper. So I was able to buy properties, renovate them, and sell them. And then the margins just started to grow as the strategy evolved. And I also started buying my buy and hold properties, which are mainly multifamily. In New Zealand, there are mainly small multifamilies, up to maybe 4 or 5. The biggest I ever seen was around maybe 10 units or so. There's no purpose-built apartment communities like we have here in the US. So I built a portfolio over the last close to 2 decades of a residential multifamily in New Zealand and commercial real estate, which is mainly triple net lease, strip mall, and I had some industrial as well. The difference between the triple net lease, if you're not familiar with that term, is basically that the tenant is paying for all the outgoing, all the expenses, and it's basically a net income. That's why it's called triple net lease. Very good hands-off investment, typically less management intensive. Those commercial tenants do take care of the property. They operate from those premises, so they want to make the property presentable. If they have a problem, they ring the trade professional. And also the leases are drafted in a way that they need to pay and address all the minor issues. It's not like a residential lease, if you like. Mm-hmm. Yes, and from there, I built a portfolio in New Zealand, which appreciated significantly. Over the last few years, maybe close now to 6 years, the market in New Zealand where I invest, which is mainly in Auckland, which is the economic hub of New Zealand, if you like, have appreciated so much, which it became a market where the price to rent ratios don't make sense anymore. So as you can compare it to a market like Boston, like Seattle, like New York, like Los Angeles, those markets are markets which the price to rent ratio don't make sense. There's no yield play over there. The main growth in your wealth will come from capital gain in those markets. So after a few years of building a portfolio and whatever I bought, 15 years ago, so those properties, they cash flow because I paid a certain amount and they tripled in value, and rents kept up. The rents kept up, but did not keep up with the increase of the capital gain. So they cash flow, but they're not cash flowing significant amount. For example, like the commercial property that I bought, their cash flow very well. So I decided at that point, about close to 4 years ago now, that I want to diversify, and we all want to have financial free, to be financial free, to have financial freedom, and we want to position ourselves so we can decide what we want to do every day. We decide that who we want to work with and how we want to work with. And if we want to go on vacation for a month, we want to be able to do that. That's the ideal life and where we're aspiring to get. So quickly realized that, as the saying goes, cash flow is king. And you can retire on equity if you withdraw it down for a line of credit or refinance or HELOC. But in the end of the day, you're going to burn it all. You're not going to have any equity if you're going to keep spending it and live off the equity. So the conclusion was that we need to generate a cash flow machine, if you like, that will generate a significant cash flow to support our lifestyle. And that's when I ventured into the US to invest in multifamily apartment buildings.
So I want to, wow, that's an inspiring story. Number one. Number two, I want to point out to our listeners that market cycles there are many types of market cycles, but one of them is the maturity of a market. Now, Auckland, I don't know much about it, but it sounds like you're saying, it is a very, very mature market. Now, each individual market, real estate is a very local business. Now, you can have sub-markets within a bigger market that might not be as mature, but what happens is markets they will mature. It's a circle. Now, I learned this from David Lindahl, who is multifamily investor, entrepreneur, coach, and he talks about finding markets that are in certain stages that are prematurity, that are actually in their first stage, infancy. Infancy would be what we would consider an emerging market. And it sounds like, and we're going to jump into this, Hadar, has some great stories about finding an emerging market. But I want to also point out and ask, what the switch was, I'm priced out of this, but you said, no, you know what, I'm going to find a way. How did you get from New Zealand to investing in multifamily real estate in the United States?
Well, Make it happen. Yes,
MIH.
make it happen. It's all here. It's all here. Ladies and gentlemen, friends, in the end of the day, if I can make it from New Zealand, you can do it if you're in the US and you want to invest out of state. How to make it? This is something that we're going to elaborate on now. But I just want to touch on a point that you mentioned on an emerging market, which is a simple example will be, for example, Dallas, Texas. Dallas, Texas, 7 years ago was a flat market. It was going kind of flat. There was no job growth. There is no population growth as much as we have now. And Jacksonville, Florida, for example. So Dallas was flat for so many years, but now it's a market which is maturing. The cap rates have compressed. The employment is growing. The population growth is growing. Job growth is growing. So the market it picked up such a momentum that it matured to be a very good matured market. Just as an example, there are markets but they are still, if you like, under the radar, and they are kind of more potential a linear market, which means a flat market like Dallas used to be for many years. There are some markets like that, but at the moment they are far and few between, because the economy is in generally speaking still in expansion, still doing well. So, and in fact, the mastermind that Marco and I are starting in January, we are going to be focusing on targeting those specific markets with our students, because those markets, they are doing well now because most of the country is doing well, but they are not still picked up momentum to really grow and mature. Right. So that's one of the very good point that you mentioned. It's because when you pick up the cycle of that market in the right time, you will be accelerating your success significantly more if you target and you pinpoint right. And I want to mention it as well, Clayton, so I don't forget. I actually just finished writing an ebook about the real estate cycle. So if you remind me, once I publish it, probably within the next 30 days, I will be happy to share it with the listener, and I will give you a link to put in your notes. So I've just finished writing it. I've done a bit of research on market cycle, and I've been through at least 2 cycles so far. Mm-hmm. Mm-hmm. Now let me go back to the question about choosing a market and how to make it happen when investing from out of area. Yeah. The first thing you need to do is basically do a market research. You need to, again, look into market fundamentals and establish which market is a market that it's a market that you want to invest in. I mean, you want to have a good price to rent ratio, something that will cash flow, and you want to have a market which is steady, which has good job growth. It has landlord-friendly rules, which is very important. I mean, you don't want to go and invest in New York now, when the people, a lot of landlords are suffering big time over there at the moment with the new regulation, very, very tenant-friendly and limitation on how much you can increase the rent and all of that. So you want to research the job growth, population growth. You want to really see which businesses are in place, if there are plans to expand infrastructure in that market. And there are a lot of different strategies and points, which, again, I have a free course and an ebook which I wrote down, and I'm happy to share it with the listeners.
We'll do that. Yeah, we'll definitely. We'll put that, guys, just so you know, we'll put that in the show notes so that everyone can benefit from that.
Yes, absolutely. It's an hour-long presentation. So, I mean, unless you want me to elaborate on it significantly, I think that it will be good if the listeners could just jump on that and get that, that free giveaway. It's going to, I think, add them tremendous value.
Yeah, and I think that just on the same topic, it sounds like this is evolving in the conversation to be important. Hadar is obviously skilled because of experience in understanding the concept of mature versus an infant or emerging market. That is really important because if you're investing in New York City or whatever, someone might say, a guru might say, hey, you can invest anywhere or whatever, and you can do it, just make it happen, whatever. There is a make it happen component, as Hadar is showing us. He's investing from a different continent. But what's more important is you understand reality. And the rules that govern reality is, if you're starting out in a market that's extremely mature, you're putting a disproportionate amount of challenges on your plate when you could just look maybe an hour away or 2 hours away or maybe 18 hours away and you set yourself up to succeed. So let's jump into right now. Let's jump into your experience with that hat of yours and the market that you invest in Arkansas.
Yes. First of all, I would like to say that you need to figure out your strategy. So if your strategy is to generate a certain amount of cash flow, you basically need to work backwards from that. First of all, you need to know what you can afford. If you can afford to buy something on your own, you need to exactly go to a mortgage broker or go to a community lender and find out what you can afford, because you need to know that before you even engage in any real estate transaction. And if you have limited resources, you want to start networking with the right people to be able to grow your network and perhaps team up and do a joint venture with other investors that are able to afford. And you can have the skill to find those deals, and then you can match they can bring the money, you can find the deal, and you can do deals together. I mean, that's what a lot of students do these days. So that's number one for anybody who's starting up. Figure out where you are, what you can afford, and if you can't afford, you have to be prepared to work on relationships, because your ticket to buy real estate is through relationships, through having people investing with you. Now, when you choose a market, basically you need to visit the market regularly. So initially you need to be prepared to visit the market. I would say at least if it's a drive, if it's not far, at least once a month. If it's far, even across the state or something like that, you need to be prepared to visit the market at least every 2 months at least. Now, that's just in the initial stages when you building those relationships. Your first protocol for relationship needs to be a property management company. Property management company is the number one key factor for investor when they invest out of state. So, I mean, they will be in charge on your asset. You need to have a good, reliable property management company and boots on the ground. Now, boots on the ground could be a fellow investor that you met for example, an investment community that you belong to online, or Bigger Pockets, somebody that you met. I mean, I met people in Arkansas, and I have a lot of friends there now that I met originally on Bigger Pockets. That's a great way to meet people. Is just to say, hi, I'm coming to town. Should we catch up for coffee or buy them lunch? So your boots on the ground will eventually could be a good fellow investor friends, or your property manager, or your maintenance guy, or anybody that you feel that you can trust. And when you go into the market, you really need to have those referrals. And the way to get referrals is from fellow investors who invest in the market. So again, it's a relationship-based business. You want to have a good referral for a property manager. You want to go and talk to at least 3 companies, if not 4, to make sure that they're a good fit. If you invest in small multifamily, you want to ask them how many multifamilies they manage. Do they manage only single houses, or do they do 50, 30, 60 units, or what's the size of their portfolio and their processes? How do they communicate with the investors when they're out of state? Do they have an online portal that you can log in and see your statements and all your transaction? And just asking all the questions. There's a number of questions that you can ask to identify that.
Wow. Yeah. I mean, I like how you talk about property managers. That's not directly intuitive for most people. And I found in my local market here in Pittsburgh that there is a part of Pittsburgh, the eastern part of Pittsburgh, that has starting to see some stagnant rent growth because of the particular submarket that it's in. You can still buy great cap rates, 8, 9 caps, but there's a reason. And I was hosting my local meetup here a couple of weeks ago and talking about a deal that I was looking at. And this property manager who I'd invited said, you know what, I actually have a couple of units over there that I manage. And I've been getting bad tenants and I've been getting stagnant or lower rents. Boom. That could change your investing, your whole philosophy and approach to a submarket. I love that. So what I'm hearing is property management company, but triangulate the referrals through other people meeting with bigger pockets and local meetups. What do we do after that? And so we've talked to a couple of property management companies. We still want to invest out of state. What do we do after that?
Okay, there's many things you can do after that. A property management company, though, you need to find somebody that you feel comfortable and they're willing to help you to learn the market. So you want to be able to bounce ideas from them and ask them, how is this location? How is that? I'm looking on this deal. Can you give me some market feedback? Somebody that wouldn't mind maybe having a drive-by for you and give you some feedback. So it needs to be someone who is really open to help you out to start in that market. Following up from a property management company, it all comes down to deal flow. So once you establish your relationship with the property management company, you want to of course start looking and starting to see what opportunity there are in the market there. So we're not going to talk right now about finding an accountant, because an accountant doesn't have to be in that market. That's number one. And an attorney doesn't have to be in that market, but it's preferably, especially if you're out of state, because there is a reason to that. Sometimes you'll need them to sign documents on your behalf if you're out of the state, so that's an option. But following to that, again, you're going to the deal flow. So it's the step number 2 is broker relationship.
Brokers.
Broker relationship is step number 2. I would suggest that you start also ask once you establish the relationship with the property manager, you ask the property manager to refer you to brokers that they know. And all the other fellow investors that you talk to, you can ask them to refer you to brokers. So you need to start building those broker relationships to grow your deal flow. You can go on websites like LoopNet and CityFeet and other websites which showcase multifamily if you're seeking multifamily, or even on the MLS if you're looking for small multifamily or single family, and start ringing out and start forming those relationships and communicating with them. Okay. And follow up with them regularly. I mean, we follow up with our brokers on a monthly basis. We put the broker's contact detail in a CRM system, and we monthly have a reminder to follow up with the broker. So I will also want to mention that hand in hand at the same time, which not necessarily before or after, it's important to form a relationship with the local lenders. Local community banks will be, as important as a broker, because without the money, you can't buy anything.
Yes. So we got market fundamentals. We got visiting the market regularly and building those relationships with local investors, local banks, but number one, property managers, and then the brokers. So from here, let's dive into, I love this topic, but I know that you can give us some value about maybe a deal that you've gotten, your latest deal, and maybe walk us through kind of how you got, first of all, how you had started the relationship. Kind of give us a framework from how you built the relationship with property managers or in the brokers, so we could see from behind your shoulder kind of how it worked.
Okay. So again, on a nutshell, with the property management, I got a referral to a company which I met with them, and I met with other companies, and I felt that they're a good fit. One of the reasons was that they were investors themselves. So I knew that they understand and they know that it's a business, and they care, and they own their own properties. They manage their own properties in the company, and they, I felt that they will be a good fit. And the person that referred me to them, he was somebody I could trust his judgment in that way, and I felt that it's a good fit. So that's the property management side of it. When it comes to brokers, again, I was referred to some from fellow investors which I met. I went to local meetups as well. If you go to a new market, you need to find out the local meetups, whether you're a multifamily investor or a single family investor. You can go to either or of them just for the beginning to start to get to know the local players, the local investors, and seek referrals. So I got to know brokers, and I also called brokers, which I saw they had listing, and then regularly had the time to chat with them on the phone on a monthly basis, and they get to know you. So, you establish those relationships. Every time I visit the market, I met with them for Starbucks or went for lunch or something like that. When it comes to local lender as well, it's very important to get referral, because the lenders, especially the community banks, are based on relationship big time. So if you seek a referral, you can seek a referral from your property management, from the broker you already met, or from your fellow investors in the marketplace. So then you go to the meeting with the lender. I suggest you go to at least 3 or 4 different lenders, community banks, and see which one you feel that they are the most accommodating for investors. Ask them about what kind of terms they're giving and recent deals that they've done, and what kind of market information they have to see if they know the market. You can even ask them about the current condition of the market, their opinion of the current condition of the market. One thing I can recommend is that once you decided on the market, you chosen a market, you decided to go, is to go to those local banks, especially 1 or 2 that you decided that could be a good option for you to work with, especially if you're out of area, and is to open a bank account with that bank. You want to stabilize those relationships as soon as possible. Open a bank account, whether you put $500 or $5,000, it doesn't matter, but you want to open a bank account, and preferably to get a secure credit card. So if, let's say, you put $1,000 and you get a credit card for $500 secured against your $500 deposit, so at least you could make a small monthly payment, like a subscription to some sort of a newsletter or something, for $10 a month. So you start building this credit record and credit history with that specific bank. That helped me a lot with the recent deal that I just did in Arkansas, because I already had an established relationship. I opened a bank account with them over 3 years ago, and it helped me a lot because I was an existing customer. So this is something that I highly recommend. Once you choose in the market, open a bank account with 1 or 2 of the local banks. You have an existing relationship as a client.
That is a golden nugget. Let's talk about that deal. Let's jump into that deal.
Okay. So I'm sorry, I was jumping from one thing to another. No. But I wanted to make that point.
This is incredible. That I've never heard anyone say that. Open a bank account, get a secured credit card. So they know you're serious. They know that you're invested in the relationship. And it goes back to what you were saying earlier. Real estate is a relationship business. And if it's a relationship based, absolutely. So let me tell you about the latest deal that we worked. I've just closed on a month ago. Basically, being in out of the state, I was doing a lot of broker relationship, and I found some deal. I bought a property a year in the last 3 years, but I wanted to buy a larger property, and I know that there are a few communities which were interest to me, because I do a lot of driving for dollars, and I go to the market and I spend a lot of time having a look on. I'm using Reonomy, for example, which is a platform where you can jump online, you can put the zip code, and it will generate a list of all the addresses of specific multifamily buildings or communities, if you like, in a specific zip code. With specific criteria that you put. For example, you can put how old is the building, and you can see how many, what year it was built. You can see how many doors there is there, and you can see even when was the last loan on the property, if they refinanced. You can see how much they owe on it. So it gives you a good idea. Maybe they owned it for many, many years, so it's mom and pop and owners which have a lot of equity or even no debt. So maybe that leads to option to get seller financing deal, if you like, or a bit more flexible terms because they don't have debt on it.
You also have an option, for example, to see when is the loan maturing. So you can approach them just before the loan is maturing. Then maybe they will be ready to sell. So anyway, I built a list. I built a list with them, and I built a list with the list source. And I mailed out letters to those markets. I've done it in Jacksonville as well. And I mailed out those letters, and I got some phone calls back. So I worked with those leads, and some of them I bought 3 properties from that, and some of them I'm putting it in if you want, a deal tracker spreadsheet, and I regularly follow up with them. When I talk to them, I say, okay, I'll ring you in maybe 2 or 3 months again with their consent. They know me now, so I ring them all the time. So that's something that I do regularly. Now that deal, I built a document which, if you like, took out all the properties which I thought was really in my wheelhouse, really in the number and the size and the vintage, the year that they were built, that I would like to own. So I was looking for anything from 20 to 80 units in a specific suburbs, which is majority of 2 bedrooms, which I would like to try and target and try and buy those properties. So I created a document. I have the number of rooms, when it was built, the unit mix, even a photo of it, and everything that I know exactly what I can refer to. And of course, the owner's contact details. So I sent a letter. Nobody called me back for that specifically property. So what I did is I rang them. I did some cold calling as well. So I rang them in the morning. I had to wake up. I was in New Zealand at the time. I had to wake up at 5 o'clock in the morning because of the time difference and make some calls. So I rang them and I say, hello, my name is Hadar. I'm investing locally in apartment buildings here in this market. And we're looking to expand our portfolio. And we wanted to ask if you would consider selling. I bought a few properties like that by now. But I would like to say, in that particular deal, which I just closed a month ago, she said, I'll take your contact details. Some lady answered the phone. I'll take your contact details, and I'll give your number to my husband, and we'll see if he might ring you back. Never heard from him. 2 weeks later, I said, he's not ringing me back. I had an email address that was there in the system that I was using. So I took his email address, and there was few email addresses. I used 2 of them that looked to me like they could be potential good opportunity to hit them on that. And I sent an email, and I said, hello, exactly what I just said before. Hello, my name is Hadar. I'm investing locally. We wanted to know if you are interested to sell your property at such and such street. A week after that, I received an email from a local broker who knows the family. And in fact, he was engaged by the family to help them to sell their portfolio, because they have a number of other properties, commercial properties, which they are looking to do all together, bundle them up, and then do a 1031 exchange into a different asset. You need to know what 1031 exchange is basically selling a property that you own, and you can defer the tax capital gain by exchanging into a larger property next one. So you're basically transferring the money from this deal to the next one, and you don't have to pay capital gain on that. So, and they have a specific time frame to do it and specific rules, which we're not going to get into right now. But it's always quite good if you can find somebody who is in 1031, because they have to identify a property to buy, and they have to sell theirs within a specific time frame. Right. Otherwise, it's not qualified for that, and they can't save on the tax. So it's always good to find that out. So moving from that point, what was there? We try and negotiate on the price, and they told me, yes, he wants 1.6 million for it, which was way over what I thought it was worth. I thought at the time that it was worth about 1.2. So I made him, I explained to him why. Another very good tip for your listeners here is that when you analyze a deal, and you want to give, and that's what we just talked about it in the green room, if you like, before this recording, is when you want to give a feedback to an owner or a broker, you always have to back yourself up with why you're going low or why you think that the numbers don't work in their high expectation asking price. So of course, being in the market, monitoring the market, I always keep an eye on what things are selling, and I'm also subscribed to a local newspaper, which is an online platform as well, that showcase the recent multifamily and commercial sales in the market. So I know that this and this sold for that price per unit, and I record it, and I keep that information, and then I can use that as a tool for negotiation. And I can refer back to that and say to the seller, no, Mr. Seller, this one sold for $40 a door, but it was an A-type asset with a swimming pool and a clubhouse, while your one is 1970s or 1980s, which has never been changed with a lot of deferred maintenance, with a different unit mix or something like that. So I use that for negotiation. And it's always good to come back to the broker with the why are you explaining to them why are you going to go with this lower offer.
Yeah, so that's I think that's a big point. Explain why you're offering what you're offering, and maybe it's a little more reasonable. Maybe they find they're not sticker shock, but they kind of see where you are. So, and also record how much assets are trading for. I love that. That's such a helpful tip. So let's finish up this section. We're running out of time a little bit right now, so let's finish up. Love to hear kind of how you finished up that negotiation, and we'll jump into our fire round. Okay, great. So the reason I'm taking my time on this is because this deal took 18 months to close. Oh. This wasn't the end of it. They didn't accept my offer. 6 months after that, I was always every 2 months I was coming back to them and asking them if they will be ready to sell in that price. And in that time, because I was following with the broker every 2 months, I established a very strong relationship with them. So over a year later, suddenly they decided that they would be willing to sell, and one of the buildings there had caught fire. So after that, I was not able even to offer them what I wanted to offer them because I had less unit to buy. Right. So in a long story short, when we've been in touch for 18 months, and they dealt with the insurance, and the deal went off the table, and meanwhile I always following up with the broker every 2 months, and in the end they were ready to sell, and I ended up buying this property for $1,055,000. And I told the owners, listen, you just had a fire. I will take the property as is for that price. I will clean the burnt out building. I will pay for the demolition, which was way over $20,000, and made the deal sweeter to them by being able to offer them this hassle-free sale, if you like, with that particular building that was fire damage. I would like to mention that the deal was 20 to 25% vacant. It was very challenging to find the financing, and the relationship with the bank in the end came to the table and helped me to get the deal, because the bank I had the relationship with was the bank that was funded the deal at the end. So that's the point I was coming back to. All the other banks didn't want to touch it because of the 20-25% vacancy. The loss to lease, which is the amount percentage that the properties that the rent was under market, was 35% loss to lease. So we have a 35% rental upside to the market, which is a significant amount. So yeah, that's the end of the story in a nutshell. If you want to look and see the property, you can jump on my YouTube channel at YouTube, which is Hadar Orkibi. Maybe, Clayton, you can put a link for that. I actually did the whole due diligence playlist series there, and now we're doing the repositioning videos, so you can see the deal. We anticipate I'm spending about $350,000 to $400,000 renovating this property, and the damaged building, we are not demolishing it. We walked through it with the general contractor and figured out that it will need about $130,000, and we can reinstate it. So I'm pretty much getting that building for free, only the amount of the cost that it's going to cost to renovate.
So we are not destroying that building. It's getting really good, and it's really excited. It's about 45 apartments, all 2 bedrooms, and it's going to be a great deal. It's going to be appraised for about 2 million, 2.1, depends on the day, on the appraisal.
So you're going to take out all the money that you put into it and a little more of equity because you built a relationship with a bank. You kept for 18 months, this deal dragged up. He kept following through. That is inspirational. So don't forget these tips, guys. Open a bank account. I'm doing that right away with the bank I'm working with. Get a credit card. I'm doing that right away. Stay persistent. Wow. So this is actually a perfect segue into our fire round. Because before we jump into the fire round, I want to know what are your limiting beliefs that have held you back from getting to this point in the past?
Absolutely awesome question, Clayton. Thank you. So I started looking on the U.S. Being an American citizen, I started looking in the U.S. back in 2008 in the recession. And I was doing well in New Zealand. Like I said before, the market was, my business was picking up momentum, and I was doing well, and I picked up a lot of good opportunities there. But the main limited belief that I had was that apartment buildings and all those things, they were sounding to me like they're for the big shots. They're for people who big corporations, and too complicated and scary, and just something that I didn't have enough exposure to. And to be honest, I wasn't in a position to find the right coach. If I had the opportunity to find a coach back then who would coach me into that and will help me and speed up my timeline to success, it would be massive, because I could have got into that. I had the means. My portfolio was growing. I had some opportunity financially to sell a couple of houses perhaps and shift some capital to America back then. But the limited belief was that I thought it's too big on me. I thought it's not possible. It's only for the big players. And I could not see any coaches back then. I could not see any help. I had no help. I was kind of isolated.
Wow. So get a coach, because they can help you break through those own barriers, get that accountability. That's an excellent tip. So now let's jump into our real talk fire round. So what is your number one real estate book that you'd love to share with our audience?
The number one real estate book. Wow, there's a lot of real estate book. I read a lot of books. Number one real estate book that I can think of at the moment I'll give you 2 books. I would like to give 2 books. I don't have number one. One is Wheelbarrow Profit by Jake and Gino. Very good book if you want to invest in multifamily apartments. Number 2, investing in multifamily apartments. It's called Crushing It by Brian Murray. Very, very good book as well, with a lot of case studies. I like case studies because you can learn from case studies. So those are the two great books. And another good book, if you want to get in and you want to buy 2 or 3 books for this holiday season and read them about real estate, and especially multifamily, I will also buy Ken McElroy, the Advanced Real Estate Investing book. That's about multifamily, and it's really, really good. He's one of the Rich Dad advisor.
Okay. So that's great. So what's your real talk best mindset tip?
The real estate investor mindset tip?
Your real talk best mindset tip.
Mindset, it's being persistent, putting yourself in a position when you, if I understand your question correctly, being persistent, staying focused is very, very important to get your ducks in a row, get your why. You need to know your why. You need to know why you're doing things. So your why, your motivation keeps you going when it's tough. You need to have the right mindset to make sure that you can keep going when it's tough, because this is not an easy business. It's not a get rich quick scam. So I think you really need to to have the right mindset in terms of being really clear about your why, clear about your goals, create yourself a roadmap to success, and stay focused and never give up. Never, never, ever give up. If you give up, just because before you go to your first deal, just because before you make those relationships that could help you to get into your first deal, if you give up, then you're not going to make the process.
Yeah. So I found that speaking with some of the greatest investors, multifamily investors, that there's a process. Everyone's goal oriented, but there's certain processes and habits that keep them focused, that keep them going down that path. Is there any habits that you have that maybe you would attribute to your success in real estate investing thus far?
Absolutely. So first of all, one of the biggest habits is having a clear mind. I like to wake up in the morning, almost every morning. I like to do meditation. I do anything between 10 minutes to 20 minutes meditation. I like to have my mind clear before I start the day. It helps me to make right choices, right decision in a more collective way, without knee-jerk reaction or without getting flustered with things which sometimes don't go your way. You're kind of able to look at it from the side and make the right decision. So for me, meditation is very important. The second habit is to be active, physically active. I like running. I like mountain biking with my son, especially because he's hooked on it. And I do yoga, which yoga is also a well-being thing for me. It's kind of an active meditation. And the number 3 habit is always continue learning. I'm always learning. I'm always expanding my knowledge, expanding my network, my circle of people in terms of people I could learn from. And it's very, very important, to keep reading books, keep getting yourself educated so you can grow. It's all about growth. You want to get from point A to point B, you need to see the way. You need to learn. You need to be able to expand yourself.
Wow. So before I ask my last question, how can our guests get in touch with you?
Well, you can jump on my website, which is MFIHolding.com. It's MFIHolding with a G.com. And you can even see the link over there actually for the giveaway. So if you jump on that and you can download the free ebook and the video course I was talking about, there's a link to that over there. And you can also visit us on MIH, which is making it happen, MIHmastermind.com, to learn about our mastermind coaching group that starts now in January 2020. We're accepting new applications now, and it's only limited for groups of 4 members in each group. And we have 16 people for the whole group of 2020. We're not going to accept any more people because we want to give exclusive service, Marco Barbaro and myself.
Excellent. So what's your real talk reason for our guests to get started, not tomorrow, today?
Well,
with multifamily investing.
If you want to be living the life of your dreams, life by design, be your own boss if you like, and achieve cash flow, multifamily is the perfect tool. There are many, many other benefits apart from just the cash flow. There are a lot of tax benefits and other benefits which intertwine together. I mean, multifamily, in my view, is just a great asset class because you could buy an asset, and if you buy it right, you could create wealth much faster than you could with investing in any other asset class. You can add value to those things. It's not like you can buy a share or a bond and you don't have control of that. I mean, you don't have control of the director of the company or anything like that. So it's something that it's physical. It's something that you can buy and add value to it if you get it right. But again, you make your money when you buy. So make sure you focus on the buy side.
Wow, Hadar, thank you so much. I and selfishly have learned so much from this episode. I'm going to put in, guys, it's getting to the end of the year. We have a month left in this recording. And if you want to consider getting together with Hadar, and I'm going to put the MIH Mastermind group in, and also check out his YouTube channel. which he has some incredible videos about flipping and about kind of his adventures with this 45 unit that are extremely instructional, helpful, and it's always good to learn, as he said. And that's how you grow as a multifamily investor. Thank you again, Hadar, for joining us at the Real Talk Real Estate Investing Podcast. And thank you for all of our listeners. Please subscribe and rate. And I'll again put all the information for Hadar below.